Today we want to talk about how the threat of inflation impacts your investments and some safe options for conservative investors to earn more interest than what's offered in the banks these days. What is inflation? Inflation represents the erosion of your buying power over time by the slow and steady rise of consumer prices year over year. This is the biggest threat to your savings. On average, inflation is averaged around 3% annually, so you need to be earning at least that much on your savings to keep pace. Anything less and you are actually losing purchasing power. Once you add taxes into the equation, you need to be earning even more. Let's take a look. What we show here is the often overlooked effect of taxes and inflation on your savings. Many people think that they are earning money if they have an interest rate above zero, but this isn't often the case. This chart shows the effect on a $1,000 investment if you had remained invested in 6-month CDs from 2002 to 2011. While CDs are insured and offer investors peace of mind and safety, it takes a very high savings rate to keep up with inflation and taxes. Your $1,000 invested in 2002 would actually be worth roughly $931 after 10 years. So where can you go to get a good return on your savings without having to consistently stress over your principal? Let's discuss a couple low volatility options that provide higher yields than CDs without the rocky ride of the stock market. Next in line, if you've decided that CDs don't offer enough for you, are Ginnie Mae bonds, followed by municipal bonds, and finally a well-diversified, balanced portfolio. So what are Ginnie Mae bonds? These are securities offered through the Government National Mortgage Association and are actually guaranteed by the full faith and credit of Ginnie Mae and thus the U.S. government for timely payment of principal and interest. This is the next best stop to FDIC insurance you might be used to at the bank. So how have these bonds typically performed? Let's take a look. The chart here shows how these bonds have performed and also how much interest rates have moved in the corresponding year. As we know, when interest rates rise, bond prices fall, and vice versa. The good news that we see here is that these bonds have had one negative year since 1990, and it happened to be the same year where interest rates rose by 2.5%, more in a single year than any year in recent memory. Let's look at perhaps the next best option, municipal bonds. Municipal bonds are issued by state or local governments or municipalities. Perhaps their greatest advantage is that interest from these bonds is federally tax-free and sometimes free of state income tax as well. Historically, municipal bonds have been an incredibly safe asset class to be in. Given the interest from these bonds are tax-free, we'd like to look at the tax equivalent yield, which is comparing how much interest you would need to get from a taxable investment to match the tax-free yield offered by a municipal bond. Let's take a look. As you see here, if you are in the highest tax bracket of 39.6% and you buy a 3% municipal bond, it's equivalent to a 4.9% interest rate elsewhere. As the yield on your bond rises, so does the tax equivalent yield. While municipal bond yields have come down in recent years, along with all other bonds, the tax equivalent nature of these bonds still allows you to stave off the combined threats of inflation and taxes. Traditionally, municipal bonds have been a great place to be to get interest well above what is offered in CDs and savings accounts. The options we've discussed so far are viewed as low-risk, conservative assets that historically have allowed you to generate real returns after taxes and inflation. Of course, the best performing asset class over the course of time has been stocks, with average annual returns of 12 to 16% looking back over several decades since the Great Depression. However, we know that stocks come with their fair share of ups and downs, and thus we don't recommend you invest in stocks as an alternative to CDs or savings. If your time horizon does allow you to stomach some volatility, history shows that the smoothest ride over time has been a well-diversified, balanced portfolio. Of course, past performance is no guarantee of future returns, but we've seen that the well-defined principles of diversification have served investors well over time. In summary, there are a myriad of different investments and asset classes that can suit the needs of a wide range of investors. What's important to determine are your own needs and time horizon, which will allow you and your advisor to focus on the particular investments that will be suitable in reaching your goals.